One of the biggest mistakes people make in retirement planning is that they spend their whole life asking one question: how much can I save? That question matters. But when retirement finally arrives, the question changes. It becomes this: how do I turn what I saved into income that lasts as long as I do? That is a very different problem. Saving $1 million is difficult. Turning $1 million into a lifetime income system is even more difficult because now the paycheck has stopped or is about to stop. The market will still move. Inflation will still move. Life expectancy is uncertain. Healthcare costs are uncertain. Spending needs will change. Children may still need help. One spouse may live much longer than the other. And the psychological weight of drawing down a portfolio can be much heavier than people expect. This is why retirement is not only an investment problem, it is an income design problem. Most people approach retirement with a simple rule. They ask whether they can withdraw 3%, 4%, 5%, or maybe more from their portfolio. They build the whole decision around the withdrawal rate. That is useful, but it is not the whole picture. A withdrawal rate is not an income plan by itself. It is a way of measuring how much pressure you are putting on the portfolio. The real question is broader. How much of your spending is guaranteed? How much depends on the market? How much flexibility do you have? How much certainty do you need? How much control are you willing to give up? How much legacy do you want to preserve? Those questions matter because two retirees with the same $1 million can have very different retirements depending on how income is structured. That is the first principle. The structure of retirement income can matter as much as the size of the portfolio. Let us begin with the traditional model. A couple retires at age 65 with $1 million invested. They have Social Security. One spouse receives $2,500 per month. The other receives $1,250 per month. Together, that gives them $45,000 per year of guaranteed income. They want to spend $95,000 per year. So we subtract the $45,000 of Social Security from the $95,000 of desired spending. That leaves a $50,000 gap. That gap must come from the portfolio. The portfolio is $1 million. So the first year withdrawal rate is 5%. This is where many retirement conversations begin and end. Is 5% too high? Is 4% safer? Is 3% more conservative? Can the couple spend more if markets do well? Should they spend less if markets do poorly? Those are all reasonable questions. A 5% starting withdrawal rate can be sustainable in many historical circumstances, especially if retirees are willing to be flexible with spending. Most retirees do not spend exactly the same inflation-adjusted amount every year. Spending often declines as people age. Travel may decline. Large discretionary spending may decline. Social Security provides an income floor. If markets are weak, retirees may reduce withdrawals for a time. All of that helps. But in this example, we will be conservative about spending behavior. We will assume the couple wants to spend a constant $95,000 every year, no spending decline, no voluntary cut, no natural aging reduction. They need $50,000 from the portfolio every year. That creates a clean comparison. The portfolio must carry a meaningful burden. That is the second principle. The withdrawal rate tells you how much responsibility the portfolio must carry. In this first strategy, Social Security provides $45,000 per year. The portfolio must provide $50,000 per year. So more than half of the desired spending depends on the market portfolio. That is not necessarily bad. A diversified portfolio can support retirement spending for a long time if returns are strong enough and withdrawals are managed well. In the source example, the couple invests conservatively because the portfolio is responsible for a large part of their income. They earn a 5.5% real return. Real return means after inflation that matters. If inflation is 3% and the portfolio earns 8.5% nominally, the real return is 5.5%. Thinking in real terms is cleaner because retirement spending also has to maintain purchasing power. So in this model, the couple withdraws $50,000 every year and the portfolio earns 5.5% real. What happens? The portfolio does not collapse. In fact, under the assumption, it grows. By age 70, it may be around $1,030,000. By age 80, it may be around $1,100,000. By age 90, it may be just under $1,300,000. Over 25 years, the couple withdraws about $1.3 million from the portfolio, while still ending near $1.3 million in portfolio value. That sounds remarkable. But the mechanism is simple. The portfolio is growing at a rate higher than the annual withdrawals are consuming it. The growth is doing more than replacing the spending. That is the classic retirement income framework. Social Security creates the foundation. The portfolio fills the gap. If markets deliver the assumed return, the plan can work very well. That is the third principle. A portfolio can fund retirement and still grow if its real return exceeds the withdrawal pressure. This is why many retirees do not need annuities. A well-built portfolio plus Social Security can be enough. It can provide flexibility, it can provide growth, it can leave a legacy, it can be adjusted over time, it can be rebalanced, it can be spent down if necessary. It remains under the retiree's control. Control has value, liquidity has value, upside has value, legacy has value. A portfolio-based strategy preserves those things, but it also creates dependence on the market. If the market performs well, the retiree feels confident. If the market performs poorly, the retiree may feel pressure. If a bad sequence of returns arrives early in retirement, the same 5% withdrawal can become more dangerous. If stocks fall significantly in the first few years and the retiree continues withdrawing, shares must be sold at lower prices. That can reduce the portfolio's ability to recover. This is sequence risk, and sequence risk is one of the main dangers of portfolio-funded retirement. The average return over 30 years may look fine, but the order of returns can matter greatly. That is the fourth principle. In retirement, the path of returns can matter as much as the average return. A 30% decline at age 45 is painful, but usually survivable because contributions continue and withdrawals have not started. A 30% decline at age 66 can be much more dangerous because withdrawals are happening at the same time. The portfolio is no longer only an accumulation machine, it is now an income machine, and income machines are more sensitive to timing. This is why guaranteed income enters the conversation. Not because guaranteed income is always better, not because annuities are always good, not because everyone should buy one, but because guaranteed income changes the pressure on the rest of the portfolio. If some of the spending is guaranteed by Social Security, a pension, or an annuity, then the portfolio does not have to carry the whole burden. When the portfolio burden falls, the retiree may be able to invest the remaining portfolio differently, withdraw less from it, and withstand market volatility more comfortably. That is the fifth principle. A strong income floor changes the job of the portfolio. This brings us to the second strategy, the hybrid strategy. The couple still retires at 65 with $1 million. They still receive the same Social Security benefits, $45,000 per year. They still want to spend $95,000 per year, but now they take $400,000 of the $1 million and use it to purchase a single premium immediate fixed annuity. This is often abbreviated as SPIA. A single premium immediate annuity works like this. You give an insurance company a lump sum in exchange. The insurance company promises to pay you a fixed income stream, often starting soon after purchase, and often lasting for life depending on the option selected. This is a contract. The payments are not based on stock market performance. They are promised by the insurance company. That does not mean they are risk-free in an absolute sense. The promise depends on the insurer's ability to pay and the protections available under state guarantee systems which have limits. But compared with market withdrawals, the income stream is contractually defined. That is the sixth principle. An annuity converts a portion of capital into a contractual income stream. The retiree gives up liquidity on that portion. In exchange, they receive certainty. That is the core trade-off. Now, annuities are not all the same. This is extremely important. There are many types of annuities, and some are complicated, expensive, or unsuitable for many people. The source example specifically uses a single premium immediate fixed annuity. That is one of the simpler forms. The retiree pays once, the insurer pays income, the payments begin soon. The payments are fixed unless an inflation adjustment or other option is selected. The monthly amount depends on several factors: age, gender, interest rates, payout option, guarantees, whether the payment is for one life or joint lives, whether heirs receive anything if the retiree dies early, whether the payment rises with inflation. These details matter because every guarantee changes the payout. A life-only annuity usually pays the highest monthly income because payments stop at death. If the retiree dies early, the insurer keeps the remaining value. That is why the payout is higher. A life with period certain annuity pays for life, but also guarantees payments for a minimum number of years. If the retiree dies during that period, beneficiaries receive the remaining payments because the insurer is taking on more obligation. The monthly payout is lower. A life with cash refund or return of premium feature protects heirs if the retiree dies before receiving back the original premium. If the retiree invests $400,000 and dies after receiving only $150,000, the remaining $250,000 would go to beneficiaries under that kind of provision. Again, because the insurer offers more protection, the monthly payout is lower. That is the seventh principle. Every extra protection inside an annuity reduces the starting income. There is no free design. Higher income usually means less protection for heirs or less flexibility. More protection usually means lower income. Annuity design is a trade-off. The source uses an annuity with a cash refund provision. That means the couple is not choosing the highest possible monthly income. They are intentionally lowering the payment somewhat in order to protect the family if death occurs early. In today's higher interest rate environment, a $400,000 immediate annuity purchased at age 65 might pay around $2,600 per month for a male on a life only basis and around $2,500 per month for a female on a life only basis with the refund provision. The source uses a more conservative estimate of about $2,300 per month. That is $27,600 per year. Now the income floor changes. Social Security remains $45,000 per year. The annuity adds $27,600 per year. Together guaranteed income becomes $72,600 per year. The couple still wants to spend $95,000. So the portfolio now has to fill only $22,400 per year. That is a very different retirement income structure. Before, the portfolio needed to provide $50,000 per year. Now it needs to provide $22,400 per year. That is less than half the previous portfolio burden. That is the eighth principle. Guaranteed income does not only add income, it reduces the withdrawal stress placed on the portfolio. After buying the annuity, the couple has $600,000 remaining in the investment portfolio. They need $22,400 per year from that portfolio. That withdrawal rate is about 3.73% of the remaining $600,000. Compare that to the earlier 5% withdrawal rate from the $1 million portfolio. The withdrawal pressure is lower, and because the guaranteed income floor now covers most of their desired spending, the couple may feel comfortable investing the remaining $600,000 more aggressively. In the example, the remaining portfolio earns a 7% real return. This is a key point. The annuity reduces market dependence for the spending plan that may allow the retiree to take more long-term growth risk with the remaining assets. Instead of keeping the whole portfolio conservative because it must fund the lifestyle, the couple may allow the smaller portfolio to grow more aggressively because basic income needs are better covered. That is the ninth principle. Reducing income risk can sometimes allow more investment risk in the remaining portfolio. This is counterintuitive. People often think buying an annuity makes the entire retirement plan more conservative. In one sense, yes, it creates guaranteed income, but it can also free the remaining portfolio to pursue higher expected returns because withdrawals from it are smaller and less psychologically threatening. Now, what happens under the example assumptions? The annuity pays $27,600 per year. Over 25 years, that totals $690,000. The original premium was $400,000 by age 90. The couple has received $290,000 more than the original premium. That is the longevity benefit. The longer they live, the more valuable the annuity becomes. Now look at the remaining portfolio. It starts at $600,000. It pays $22,400 per year. It earns 7% real by age 70. It may grow to a little over $700,000 by age 80. It may grow to a bit over $1 million by age 90. It may reach about $1.8 million. So under these assumptions, the hybrid plan produces a surprising outcome. The couple spends the same $95,000 per year. They receive guaranteed income from Social Security and the annuity. They withdraw much less from the investment portfolio. The portfolio grows to $1.8 million by age 90, and the annuity has paid them $690,000 by then. That is the 10th principle. An annuity can make the remaining portfolio grow faster by reducing how much must be withdrawn from it. This is not because the annuity itself is magic. The annuity does not create market upside. It creates income certainty. That certainty reduces the need to draw from the portfolio. If the portfolio is allowed to compound with lighter withdrawals, the remaining assets may grow substantially. This is why the comparison is more complicated than annuity versus portfolio. The more accurate comparison is income architecture. How does the annuity change the behavior of the rest of the system? That is the question. Now, we must be careful. Real life does not produce smooth 7% returns every year. Markets are volatile. Inflation changes purchasing power. Annuity payments in this example are fixed, so they do not rise with inflation. Social Security has inflation adjustments. Portfolio withdrawals can adjust, but the annuity income may buy less over time unless an inflation rider is purchased. And inflation riders usually reduce the starting payout significantly. The source notes that inflation-protected annuity options can reduce initial payments by 15 to 30% or more. Many retirees reject that because they need stronger income. Now, they may rely on Social Security and portfolio growth to handle inflation instead. That is another trade-off. Fixed annuity income is stable in dollars but not stable in purchasing power. That is the 11th principle. A fixed income floor can protect cash flow while still exposing purchasing power to inflation. This is why annuities must be sized carefully. If too much of the portfolio is annuitized into fixed payments, the retiree may feel safe at first but become vulnerable later. If inflation erodes the value of those payments. If too little is annuitized, the guaranteed income floor may not be strong enough to reduce portfolio pressure meaningfully. The amount matters in the example. $400,000 of the $1 million is annuitized. That is 40%. This leaves 60% invested. That balance allows both certainty and growth. But 40% may be too much for some retirees and too little for others. There is no universal number. That is the 12th principle. The right annuity allocation depends on income needs, risk tolerance, liquidity needs, health, longevity expectations, inflation exposure, and legacy goals. This is why I am not pro-annuity or anti-annuity. I am pro-framework. Some retirees benefit enormously from guaranteed income. Others should avoid annuities entirely. The decision depends on the system. Now, let us examine the mental shift. When people have an investment portfolio, they often develop an unconscious rule: spend the growth but never touch the principal. This rule feels safe. If the portfolio starts at $1 million, they want to keep it at $1 million or higher forever. They may feel anxious every time the balance falls below the starting point. They may see withdrawals as damage. An annuity works differently. When you buy an annuity, you intentionally convert a portion of the portfolio into income. You are accepting that this portion is no longer a liquid account balance. It becomes a stream of payments. You are not trying to preserve that principal in the same form. That can feel uncomfortable. It requires a mental reclassification. $400,000 is no longer money you can look at in a brokerage account. It is now an income contract. That is the 13th principle. Annuitization requires moving from balance sheet thinking to income stream thinking. Some people love that. They do not want to worry about markets. They want the payment to arrive. They want the certainty. They want to know that basic spending is covered. Other people hate that. They want access. They want control. They want the ability to change investments. They want to leave more to heirs. They do not want to hand money to an insurer. Neither reaction is irrational. It depends on personality, goals, and circumstances. Now, let us talk about control. Control is one of the biggest costs of an annuity. If the money remains in the portfolio, you control it. You can withdraw more in an emergency. You can spend on healthcare. You can help a child. You can change investments. You can rebalance. You can sell. You can leave whatever remains to heirs. When you annuitize, that lump sum is no longer accessible. You exchange liquidity for guaranteed income. That is a real cost. If a large expense appears, the annuity principal is not available to solve it. You only receive the scheduled payments. That means you must keep enough liquid portfolio assets outside the annuity. This is why no one should annuitize money they may need for emergencies or major discretionary goals. That is the 14th principle. Guaranteed income is valuable only if you do not sacrifice too much liquidity. A retirement plan needs both income and flexibility. An annuity can provide income. A portfolio provides flexibility. The art is deciding how much of each you need. Now, inheritance. A portfolio can leave remaining assets to heirs. If the retiree dies early, the heirs may receive a large amount. If the retiree lives long and spends heavily, heirs may receive less. But the portfolio remains part of the estate unless spent. An annuity changes inheritance. If it is life only and death occurs early, payments stop and heirs may receive nothing from that annuity. If it has a cash refund provision, heirs may receive unused principal if the retiree dies before receiving back the original premium. That protects against the most uncomfortable early death outcome. But even with a refund provision, the annuity is still different from keeping the money invested. If the retiree dies early and markets have performed well, the heirs may inherit less than they would have if the entire $1 million remained invested. If the retiree lives into their late 80s or 90s, the annuity may pay far more than the original premium, and the remaining portfolio may grow because withdrawals were lower. Longevity determines part of the outcome. That is the 15th principle. Annuities transfer longevity risk from the retiree to the insurer, but they also change the inheritance profile. This is the essence of insurance. The insurer pools longevity risk across many people. Some die early, some live long. The insurer prices the contract based on mortality assumptions, interest rates, and guarantees. The retiree buying the annuity receives protection against the risk of outliving assets, but gives up some access and potential legacy. That may be a good trade. It may be a bad trade. It depends. Now, let us think about longevity risk more deeply. Longevity risk is the risk of living a very long time. Most people think living long is a blessing. It can be, but financially long life creates risk because expenses continue. Healthcare may rise, inflation erodes purchasing power. Market cycles repeat, a portfolio must last longer. If you retire at 65 and live to 95, you need 30 years of income. If one spouse lives to 100, the money must last 35 years. This is why annuities can be attractive. They pay for life. The longer you live, the more valuable the contract becomes. A portfolio can also last for life if withdrawals are managed and markets perform well. But there is no contract guaranteeing that a portfolio will provide a specific income until death. That is the 16th principle. Longevity turns uncertainty into a financial liability. Guaranteed lifetime income is one way to transfer part of that liability. Social Security is already a form of lifetime income. A pension is another. An annuity can create a private version of that income. The more guaranteed lifetime income you have, the less your survival depends on market performance. But again, too much guaranteed fixed income can reduce liquidity and inflation flexibility. Balance matters. Now, let us compare the two strategies in psychological terms. Strategy 1 is portfolio plus Social Security. It gives high control, it gives high liquidity, it may leave a strong legacy, it can grow if markets cooperate, but it depends more on the market to fund spending. The retiree must be comfortable withdrawing $50,000 per year from the portfolio. They must tolerate volatility. They may need to adjust spending if markets perform poorly. Strategy 2 is Social Security plus annuity plus portfolio. It gives stronger guaranteed income. It reduces portfolio withdrawals. It may allow more aggressive investment with remaining assets. It can reduce anxiety about monthly income, but it gives up liquidity and control over the annuitized portion. It may reduce inheritance if death occurs early. It may expose fixed annuity payments to inflation erosion. Both strategies can work. Both can fail if poorly matched to the person. That is the 17th principle. Retirement income design is not about finding the universally best product. It is about matching trade-offs to the retiree's real fears and goals. If the retiree's greatest fear is outliving money, guaranteed income may have high value. If the retiree's greatest goal is leaving a large inheritance, annuitizing too much may conflict with that goal. If the retiree values flexibility and has high risk tolerance, a portfolio strategy may fit. If the retiree feels anxious during market declines and needs predictable income, a hybrid strategy may fit. Now, let us think about spending flexibility. The source assumes constant spending to make the example conservative and simple, but real retirees often reduce spending over time. Travel, hobbies, and discretionary expenses may be higher in early retirement. Later, some categories decline. Healthcare may rise, but lifestyle spending may fall. If spending declines naturally, both strategies improve. In the portfolio only strategy, lower later withdrawals reduce pressure on the portfolio. In the hybrid strategy, lower portfolio withdrawals allow the remaining portfolio to compound even more. The first spending cuts usually come from portfolio withdrawals because Social Security and annuity payments continue. That means the hybrid plan may become even stronger if the retiree spends less later. That is the 18th principle. Spending flexibility is one of the most valuable assets in retirement. A retiree who can reduce spending during bad markets has much lower risk. A retiree with rigid spending needs has higher risk. Guaranteed income reduces the amount that must be flexed, but it does not eliminate the need to think about spending. Now let us consider inflation again. Social Security adjusts with inflation. Portfolio withdrawals can be increased or decreased to reflect needs and market conditions. But a fixed SPIA without inflation adjustment does not grow. At age 65, $27,600 per year may feel meaningful at age 85. After 20 years of inflation, the purchasing power may be much lower. This is why the annuity should not be the only inflation strategy. The remaining portfolio must grow. Social Security helps. Spending adjustments help. Some retirees may choose inflation-adjusted annuities, but the lower initial payout must be considered. That is the 19th principle. Fixed guarantees solve one risk while leaving another risk alive. They solve market risk and longevity risk for that income stream. They do not fully solve inflation risk. Every retirement tool solves some problems and creates or leaves others. This is why product sales are dangerous when they present only the solved problem. A good advisor shows the trade-offs. Now, let us talk about interest rates. Annuity payouts depend heavily on interest rates because insurance companies invest premiums largely in long-term bonds and fixed income instruments. When rates are higher, insurers can generally offer higher payments. When rates are lower, payouts decline. That means the annuity decision is partly tied to the rate environment. In a higher interest rate world, annuity payouts can look more attractive. In a low rate world, they may look less attractive. Age matters too. The older you are when you buy, the higher the payout tends to be because the insurer expects to pay for fewer years. Gender matters because women tend to live longer, so payouts may be slightly lower for women in certain single life annuity designs. Guarantees matter because more guarantees mean lower income. That is the 20th principle. An annuity payout is not arbitrary. It is a function of interest rates, life expectancy, and contract guarantees. This is why timing and design matter. Buying an annuity at 65 in a higher rate environment is different from buying one at 65 in a very low rate environment. Buying life only is different from buying cash refund. Buying single life is different from joint life. Buying fixed is different from inflation. Adjusted, the details change the outcome. Now let us think about joint life risk. The source example is a married couple, but the annuity quote is discussed simply around a $400,000 purchase and a $2,300 monthly payout with refund. In real life, a married couple would need to decide whether the annuity covers one life or both lives. A joint life annuity continues payments as long as either spouse is alive, but the monthly payout is usually lower than a single life annuity because the insurer expects to pay longer. This is not an optional detail. If one spouse dies and the annuity stops, the surviving spouse may be exposed. For couples, survivor protection matters. That is the 21st principle for married retirees. The income plan must protect the longer living spouse. Retirement planning is not only about the couple while both are alive, it is also about the survivor. Social Security survivor benefits, pension survivor elections, annuity payout structure, portfolio assets, taxes, and spending all change after the first death. A plan that works for two people may not automatically work for one. Now, let us talk about sequence risk in the hybrid plan, because the portfolio withdrawal need falls from $50,000 to $22,400. Sequence risk is reduced. If markets fall, the couple does not need to sell as much from the portfolio to maintain spending. Social Security and the annuity keep arriving. The portfolio can be left alone more easily. This can change behavior. A retiree who only needs $22,000 from a $600,000 portfolio may be less likely to panic than one who needs $50,000 from a $1 million portfolio. The percentage withdrawal is lower. The income floor is stronger. The emotional stress is lower. That is the 22nd principle. Lower required withdrawals reduce both mathematical risk and behavioral risk. Behavioral risk matters because retirees are human. A retiree who panics and sells during a decline may destroy a plan that would have worked if they stayed invested. A stronger income floor can help them stay rational. That is valuable. Now let us discuss the objection. Why would I give $400,000 to an insurance company when I can invest it myself? That is a fair question. If you have high risk tolerance, strong spending flexibility, a long-term mindset, a desire to leave a legacy, and enough guaranteed income from Social Security or pensions, you may not need an annuity. The portfolio may be better. It preserves control. It preserves upside. It preserves liquidity. It can leave more to heirs. But if you are uncomfortable with market dependence, if you fear living too long, if you have no pension, if your Social Security does not cover enough, or if you need a stronger floor, the annuity may buy something valuable. It buys certainty. The question is whether certainty is worth the cost. That is the 23rd principle. The annuity decision is the price of certainty. Some people should pay it. Some people should not. Now let us compare this to insurance. You do not buy homeowners insurance because you expect your house to burn down. You buy it because the outcome would be devastating if it did. You do not buy life insurance because death is profitable. You buy it because your family needs protection. You do not buy an annuity because it has the highest expected return in every scenario. You buy it because outliving your money is a risk you want to transfer. That is the insurance logic. Insurance is not designed to maximize expected wealth in all scenarios. It is designed to protect against unacceptable outcomes. That is the 24th principle. The purpose of insurance is not to win the average scenario. It is to survive the dangerous scenario. An annuity is longevity insurance. If you die early, it may look like a poor financial trade unless refund features protect principle. If you live very long, it may be extremely valuable. This is why health, family, longevity, spouse needs, and psychological comfort all matter. Now let us talk about the legacy question. Many retirees say they want to leave money to heirs. That is understandable. But there is a hierarchy. First, the retirement plan must support the retiree and spouse. Second, it should manage risk. Third, it can think about legacy. If preserving inheritance causes the retiree to live with constant fear of running out of money, the plan may not be serving its primary purpose. At the same time, if the retiree has ample resources and values legacy highly, annuitizing too much may be unnecessary. That is the 25th principle. Legacy is important, but retirement security comes first. A cash refund provision can help balance this. It protects heirs if the retiree dies before receiving back the premium. It does not preserve all the upside of investing, but it reduces the emotional discomfort of losing the entire premium after an early death. Again, design is trade-off. Now let us think about the break-even concept. If a retiree pays $400,000 for an annuity that pays $27,600 per year, the simple payback period is about 14.5 years before considering time value of money. If the retiree lives beyond that, the total payments exceed the original premium. By age 90, over 25 years, total payments are $690,000. But simple payback is incomplete. The $400,000 could have been invested. The annuity payments could have been spent or invested. Interest rates matter, inflation matters, taxes matter, longevity matters. The insurer's pricing includes these assumptions. That is the 26th principle. An annuity break, even is useful, but it is not the whole decision. The real question is not only when the payments exceed the premium, it is what risk the payments remove and what opportunity the retiree gives up. Now let us discuss taxes briefly. The source does not go deeply into taxes, but in real life taxation matters. Annuity payments may be partly taxable depending on whether the annuity was purchased with qualified or non-qualified funds. Retirement account withdrawals may be taxed. Social Security taxation depends on income. Portfolio withdrawals may include capital gains, dividends, interest, or return of base estate taxes may apply. Tax structure can change the net income picture. That is the 27th principle. Retirement income must be measured after taxes. Not only before taxes, a gross $95,000 of spending need is not the same as the income required before taxes. Different income sources have different tax treatment. A good plan should model net spendable income, but the source S-core lesson still holds. Income structure changes risk. Now let us think about real returns. The example uses real returns of 5.5% for the more conservative portfolio and 7% for the more aggressive portfolio. These are strong assumptions. They may be reasonable in a model, but they are not guaranteed. Future returns could be lower. A low return environment would make the portfolio only strategy more fragile. It would also make the hybrid strategy different, though the guaranteed income would still arrive. If returns are lower than expected, the value of guaranteed income may rise because the portfolio struggles more. If returns are higher than expected, the portfolio-only strategy may outperform and leave more legacy. That is the 28th principle. The relative value of guaranteed income rises when market returns disappoint. This is why no single historical average should decide the question. The retiree must think in scenarios: strong markets, weak markets, high inflation, long life, short life, high spending, reduced spending, early death, surviving spouse. The plan should be tested across these outcomes. Now, let us think about regret. If you buy the annuity and die early, heirs may regret that money was not left invested, though the refund provision can soften the outcome. If you do not buy the annuity and live to 95 during poor markets, you may regret not having more guaranteed income. If markets boom and you annuitized, you may regret missing upside. If markets crash and you did not annuitize, you may regret relying too heavily on the portfolio. Retirement decisions are made under uncertainty. Regret cannot be eliminated. It can only be managed. That is the 29th principle. A good retirement plan reduces catastrophic regret, not all regret. You cannot design a plan that wins every possible future. You design a plan that can survive many futures and match your deepest priorities. If your priority is maximum legacy, choose differently. If your priority is lifetime income security, choose differently. If your priority is flexibility, choose differently. If your priority is emotional peace, choose differently. Now let us talk about the role of Social Security. Social Security is a powerful income floor. In the example, it provides $45,000 per year. That is nearly half the couple's desired spending. It is inflation adjusted and lasts for life. This is why Social Security plays such a major role in retirement planning. If Social Security covers a large share of spending, the portfolio can take less pressure. If Social Security covers only a small share, the portfolio must do more. This is why claiming strategy matters. A higher Social Security benefit can function like a larger annuity. Delaying Social Security, when appropriate, can increase guaranteed lifetime income, but that decision depends on health, cash flow, marital status, survivor benefits, and break. Even analysis, the source does not focus on claiming strategy, but the broader principle is relevant, the 30th principle. Social Security is the first income floor most retirees already own before buying more guaranteed income. Understand the guaranteed income you already have. If Social Security plus a pension covers basic needs, an annuity may be unnecessary. If Social Security alone is not enough, an annuity may deserve consideration. Now, let us discuss pensions. A pension is another income floor. If a retiree has a strong pension plus Social Security, they already have significant guaranteed income. The portfolio may be used for discretionary spending, inflation protection, and legacy. In that case, annuitizing may provide less additional value if there is no pension. The annuity can replace part of that missing floor. That is the 31st principle. An annuity is often most useful for retirees who lack enough existing guaranteed income. The income floor is the key, not the product. If the floor is already strong, the product may be unnecessary. If the floor is weak, the product may help. Now, let us talk about the idea of essential versus discretionary spending. A strong framework divides retirement spending into two categories: essential spending, discretionary spending. Essential spending includes housing, food, utilities, healthcare, insurance, taxes, and basic transportation. Discretionary spending includes travel, gifts, hobbies, entertainment, luxury purchases, and flexible lifestyle items. The more essential spending is covered by guaranteed income, the more secure the retirement feels. If Social Security and annuity payments cover essential spending, the portfolio can be used more flexibly for discretionary spending. If markets fall, discretionary spending can be reduced without threatening basic life. That is the 32nd principle. Guaranteed income is most valuable when it covers essential expenses. Do not annuitize just to create income. Annuitize, if appropriate, to cover the spending that must happen regardless of market conditions. This is how income floors create stability. Now let us connect this to the example. The couple wants $95,000 per year. Social Security gives $45,000. Annuity adds $27,600. Together, guaranteed income is $72,600. If their essential spending is around that level, then the portfolio becomes primarily a flexible supplement that changes the entire emotional experience of retirement. The portfolio no longer feels like the only lifeline. It becomes growth capital and discretionary support. That is powerful. The 33rd principle. When guaranteed income covers the foundation, the portfolio can become an opportunity asset instead of a survival asset. This is why the remaining portfolio can be invested more aggressively. In the hybrid example, the couple is not withdrawing $50,000 from it. They are withdrawing $22,400. The portfolio has more breathing room. Now let us talk about annuity criticism. Annuities are often disliked because they can be sold aggressively, come in confusing forms, have high commissions, include complicated riders, and sometimes lock retirees into products they do not fully understand. That criticism can be valid. But a bad product sales culture does not mean every annuity is bad. A simple SPIA can be a clean tool when used properly. The problem is not the word annuity. The problem is misuse, over-allocation, complexity, high cost, poor suitability, and lack of understanding. That is the 34th principle. Do not judge a financial tool only by the worst way it is sold. Judge it by whether it solves a real problem at a reasonable cost. Annuities solve longevity and income certainty problems. They do not solve liquidity. They do not maximize inheritance in all scenarios. They do not automatically beat a strong portfolio. They are tools. Tools must be matched to tasks. Now let us talk about portfolio. Only criticism. Some people believe annuities are unnecessary because the market will do better. That may be true for many retirees, but it assumes the retiree can tolerate volatility, maintain withdrawals, avoid panic, and live with uncertainty. Not every retiree can. A mathematically optimal plan that causes emotional distress may fail in real life. If guaranteed income prevents panic selling, it may improve outcomes, even if expected return is lower. That is the 35th principle. The best plan on paper is not the best plan if the retiree cannot live with it. Retirement planning must be behavioral, not only mathematical. Now let us think about the couple in the source under the portfolio. Only plan, they withdraw $50,000 per year and the portfolio grows to around $1.3 million by age 90 under the assumptions. Under the hybrid plan, they buy a $400,000 annuity, withdraw only $22,400 per year from the remaining $600,000 portfolio, and the portfolio grows to around $1.8 million by age 90 under the assumptions. They also receive $690,000 from the annuity over 25 years. This result may surprise people because they assume giving up $400,000 must reduce the estate, but because withdrawals from the remaining portfolio are much lower and the portfolio can be invested more aggressively, the remaining assets can compound more. That is the 36th principle. The best retirement income plan may not be the one that keeps the largest portfolio on day one. It may be the one that creates the best balance between income security and portfolio growth over time. But again, this depends on assumptions. If the aggressive portfolio does not earn 7% real, the ending value may be lower. If inflation is high and fixed annuity income loses purchasing power, spending may require more portfolio withdrawals later. If the retiree dies early, the portfolio-only plan may leave more to heirs. If the retiree lives long, the annuity becomes more valuable. That is why scenario analysis is essential. Now, let us talk about guaranteed income and aggressiveness. Some people might say, if I buy an annuity, I should become more conservative because I already gave up money. But the source shows the opposite possibility. Because the annuity and Social Security cover much of the spending, the remaining portfolio can accept more risk. This is similar to having a pension. A retiree with a strong pension may be able to hold more equities than a retiree with no pension because their basic income is secure. The pension is bond, like or annuity, like. It reduces the need for the portfolio to be the only income source. That is the 37th principle. Guaranteed income can function like a stabilizing asset on the household balance sheet. If you view Social Security pensions and annuities as part of the total household income system, then the investment portfolio can be designed around the remaining risk. This is total portfolio thinking, not just brokerage. Account thinking. Now, let us think about the source. Ending point. The speaker is not pro-annuity or anti-annuity. That is the right stance. Being ideological about annuities is a mistake. Some advisors hate them, some sell them too aggressively. Both extremes are dangerous. The right question is not whether annuities are good. The right question is whether a specific annuity solves a specific retirement income problem for a specific person at a reasonable cost and with understood trade-offs. That is the 38th principle. No product is good or bad in isolation. Suitability comes from the match between the product and the problem. Now, let us build a decision framework. First, determine your desired spending in the example. It is $95,000 per year. Second, identify guaranteed income already available. Social Security is $45,000. Third, calculate the income gap. The gap is $50,000. Fourth, determine whether the portfolio can reasonably fill that gap under conservative assumptions. With $1 million, that is a 5% withdrawal rate. Fifth, evaluate your comfort with market dependence. Can you tolerate withdrawing $50,000 during a bear market? Can you reduce spending if necessary? Can you stay invested? Sixth, consider whether buying guaranteed income reduces the portfolio burden. A $400,000 annuity adds $27,600 per year, lowering the portfolio gap to $22,400. Seventh, evaluate the trade-offs. Liquidity lost, control lost. Legacy changed. Inflation risk, insurer risk. Remaining portfolio allocation. Eighth, run scenarios: early death, long life, weak markets, strong markets, high inflation, reduced spending, healthcare shock, surviving spouse. Ninth, decide whether the certainty is worth the cost. That is the 39th principle. The annuity question should be answered after mapping the income gap, not before. Do not start with the product, start with the gap. How much income must the portfolio produce? How much of that income is essential? How much guaranteed income already exists? How much uncertainty can you tolerate? Only then can you decide whether more guaranteed income is useful. Now, let us talk about the emotional experience of withdrawal. Many retirees have spent 40 years saving. They were rewarded for not touching the portfolio. They watch the balance grow. Then retirement arrives and suddenly they must reverse the behavior. They must take money out. That can feel wrong. Even if the math works, the psychology can be hard. An annuity can help because it turns a portion of savings into a paycheck. Like Stream, the retiree does not have to sell investments each month for that portion. The payment arrives that can feel familiar and comforting. This is an underrated benefit. That is the 40th principle. Retirement income should be designed for human behavior, not just spreadsheet efficiency. If a retiree cannot comfortably spend from a portfolio, they may underspend and live with unnecessary anxiety, or they may panic during market declines. A guaranteed income stream can make spending easier and reduce stress. This has real value, but it must be weighed against liquidity and legacy. Now let us consider healthcare and long-term care. The source does not go into this deeply, but any retirement income decision must consider large, unexpected costs. If too much money is annuitized, liquidity may be insufficient for care needs, home modifications, family support, or major medical events. If too little income is guaranteed, the retiree may be exposed to market risk while paying for rising healthcare costs. This is why the portfolio must remain large enough and liquid enough. In the hybrid example, $600,000 remains invested after the annuity purchase. That preserves significant flexibility. If someone with $1 million annuitized $800,000, the income floor might be stronger, but flexibility could be dangerously low. That is the 41st principle. The more uncertain your future expenses, the more liquidity you should preserve. Annuities work best when the retiree can clearly distinguish money needed for guaranteed income from money needed for flexibility. Now let us talk about inflation. Adjusted annuities. They solve one problem but create another. If payments rise with inflation, the retiree receives better purchasing power protection, but the starting payment is much lower. The retiree may receive less income in the early years when they may be more active and spending more. If they die earlier, they may never fully benefit from the inflation adjustment. A fixed annuity gives higher starting income but loses purchasing power over time, which is better. It depends. That is the 42nd principle. Inflation protection is valuable, but its cost must be compared with the retiree's spending pattern and life expectancy. Some retirees may choose fixed annuity income for essential baseline spending and rely on Social Security and portfolio growth to address inflation. Others may prefer inflation adjusted income even with a lower starting payment. Again, trade-off. Now, let us think about market valuation at retirement. If the market is highly valued when you retire expected, future returns may be lower and sequence risk may be higher. Guaranteed income can be more valuable in that environment. If the market is reasonably valued and the retiree has flexibility, portfolio withdrawals may be more attractive. Interest rates also matter. Higher interest rates may improve annuity payouts and bond returns. Lower interest rates may reduce annuity payouts and make guaranteed income more expensive. That is the 43rd principle. The retirement income decision is affected by both market valuations and interest rates at the time of retirement. This is why retirement planning should be updated near retirement. A strategy chosen 10 years earlier may not be ideal when actual rates and valuations are known. Now let us discuss partial annuitization. The source hybrid plan is not all or nothing. That is important. Many people debate annuities as if the choice is 100% portfolio or 100% annuity. That is usually the wrong framing. Partial annuitization can be powerful because it buys an income floor while preserving a portfolio for growth and flexibility. In the example, 40% is annuitized and 60% remains invested. That creates a blend. The retiree does not have to choose certainty or flexibility completely. They can own both. That is the 44th principle. The best retirement income strategy is often a blend, not an extreme. Social Security is one layer. An annuity or pension may be another layer. The portfolio is another layer. Cash reserves are another. Each layer has a job. Now let us define the job. Social Security provides inflation, adjusted lifetime income backed by the government. An annuity provides contractual lifetime income backed by an insurer. The portfolio provides growth, liquidity, inflation protection potential, and legacy. Cash provides near-term stability. Insurance may protect against health or long-term care risks. Estate planning controls transfer and legacy. A retirement plan is the coordination of these layers. That is the 45th principle. Retirement security comes from matching each risk with the right tool: longevity risk, market risk, inflation risk, liquidity risk, spending risk, health risk, legacy risk. No single tool solves all of them. Now let us talk about what happens if markets underperform in the portfolio. Only strategy if the $1 million portfolio earns less than 5.5% real and withdrawals remain $50,000 per year, the portfolio may not grow as projected, it may decline. If the bad returns come early, the risk is greater, the retiree may need to reduce spending, rebalance, change allocation, use cash reserves, or accept a lower legacy. The hybrid strategy reduces this risk because only $22,400 is being withdrawn from the portfolio, but it is not immune. If markets underperform badly, the remaining portfolio may still disappoint. The annuity continues, but inflation and liquidity issues remain. That is the 46th principle. Guaranteed income reduces portfolio risk, but it does not eliminate retirement risk. A retiree still needs a plan for inflation, healthcare, taxes, and unexpected spending. Now, let us think about what happens if markets outperform. In a strong market, the portfolio-only strategy may do extremely well. Keeping the full $1 million invested allows all assets to benefit from market growth. The retiree maintains flexibility and may leave a large legacy. The hybrid strategy may also do well, especially because the remaining portfolio can be more aggressive and withdrawals are lower. But the annuitized $400,000 no longer participates in market upside. So in very strong markets and normal longevity, the portfolio-only plan may compare favorably. That is the 47th principle. Annuities give up some upside in exchange for certainty. That is not a flaw. It is the trade. The retiree must decide whether the upside is worth the uncertainty. Now, let us talk about early death. If the retiree dies early, the portfolio-only strategy usually preserves more estate value, assuming markets have not collapsed. The hybrid strategy with cash refund can return unused premium, but the heirs may still receive less than if the full portfolio remained invested. This is one of the hardest emotional objections. Nobody wants to give up capital and then die early. Refund provisions help, but they reduce income. That is the 48th principle. Protection for heirs reduces income for the retiree. Every annuity option balances these interests differently. Life only favors the highest retiree income. Cash refund or period certain favors some heir protection. Joint life favors spouse protection. Inflation riders favor purchasing power. All reduce starting income compared with the most basic option. Now let us discuss decision paralysis. Retirees often get stuck because every option has trade-offs. Portfolio only has risk. Annuities have loss of control. Cash has inflation risk. Bonds have interest rate risk. Stocks have volatility. Spending less reduces lifestyle. Spending more increases risk. There is no perfect solution. The absence of a perfect solution does not mean no solution exists. It means the retiree must prioritize. That is the 49th principle. Retirement planning is the art of choosing which uncertainty you are most willing to live with. Do you want market uncertainty? Longevity uncertainty, inflation uncertainty, liquidity uncertainty, legacy uncertainty. Every plan contains some. The goal is to choose intentionally. Now, let us talk about the role of an advisor. A good advisor should not simply sell an annuity or dismiss one. They should model income needs. Guaranteed income, spending flexibility, portfolio risk, taxes, inflation, longevity, survivor needs, and legacy goals. They should compare alternatives. They should explain fees and insurer strength. They should show what happens in good and bad scenarios. A bad advisor starts with a product. A good advisor starts with the client's income problem. That is the 50th principle. Advice is valuable when it clarifies trade-offs, not when it hides them. If someone is paid to sell an annuity, be cautious. If someone hates all annuities without analysis, be cautious too. The tool deserves evaluation. Now let us think about how a retiree can decide whether they value certainty enough. Ask these questions. If the market fell 30% in the first year of retirement, would I cut spending or panic if I lived to 95? Would I feel secure with portfolio withdrawals alone if I died at 72? How important is maximizing inheritance? How much of my spending is essential? How much guaranteed income already covers that essential spending? How much liquidity do I need? Do I trust myself to stay invested through volatility? Do I want a paycheck, like income stream? Would losing access to a lump sum bother me more than market uncertainty? These questions reveal the true decision. That is the 51st principle. The annuity decision is personal because risk tolerance is personal. Mathematics narrows the range. Psychology chooses the fit. Now, let us return to the two retirement pictures. In the first picture, the couple has $45,000 of guaranteed income and a $1 million portfolio. The portfolio must fill $50,000 per year. If returns are good, the portfolio can grow, and legacy can remain strong. The retiree keeps control. In the second picture, the couple has $72,600 of guaranteed income and a $600,000 portfolio. The portfolio must fill only $22,400 per year. If returns are good, the smaller but more aggressive portfolio can grow dramatically. The retiree gives up liquidity on $400,000 but gains a stronger income floor. Both pictures can lead to spending $95,000 per year. The path feels different. That is the 52nd principle. The same spending level can feel very different depending on how much of it is guaranteed. A dollar from Social Security does not feel like a dollar withdrawn during a market crash. A dollar from an annuity does not feel like a dollar that requires selling investments at depressed prices. Certainty has emotional value. Now let us think about retirees who underspend. Some retirees with large portfolios still do not spend because they fear running out. They may die with far more than expected, not because that was their goal, but because uncertainty kept them from enjoying their money. A stronger income floor can give such retirees permission to spend. This is an important point. An annuity may not only protect against running out, it may help people enjoy retirement more comfortably. That is the 53rd principle. Guaranteed income can increase spending confidence, not just survival probability. If a retiree knows basic income arrives every month, they may feel more comfortable using the portfolio for travel, family, or experiences. For some people, that is worth a lot. Now let us talk about retirees who overspend. An annuity will not fix overspending if the retiree spends beyond the income plan. If guaranteed income creates a false sense of security and the retiree drains the portfolio irresponsibly, the plan can still fail. The annuity covers only the contracted payment. The portfolio still requires discipline. That is the 54th principle. Guaranteed income is a floor, not a license to ignore spending discipline. A retirement plan still needs budgeting. Even with Social Security and annuity income, spending must be monitored. Now let us consider the risk of insurer default. The source does not emphasize it, but annuity payments depend on the insurance company. Insurers are regulated and must hold reserves, but there is still counterparty risk. State guarantee associations provide some protection up to limits, but those limits vary and are not the same as federal guarantees. This does not mean annuity should be avoided. It means insurer quality matters. That is the 55th principle. A guarantee is only as strong as the institution and legal structure behind it. When buying an annuity, retirees should consider insurer strength, ratings, state guarantee limits, diversification across insurers, if purchasing large amounts, and contract terms. Do not chase the highest quote blindly. Now, let us talk about the emotional discomfort of handing over money for many people. Saving $1 million took decades. Giving $400,000 to an insurance company can feel like losing the money, even if the income stream is valuable. The loss of visible account balance can be psychologically painful. This must be respected. If a retiree cannot emotionally tolerate the loss of control, they may regret the purchase even if the math works. That is the 56th principle. A retirement income strategy must fit the retiree's emotional accounting. Money in an account feels different from income in a contract. Both have value, but they feel different. Good planning recognizes that. Now let us think about how the hybrid plan can affect asset allocation. In the portfolio only strategy, the couple uses a conservative portfolio earning 5.5% real because withdrawals are significant. In the hybrid strategy, they use a more aggressive portfolio earning 7% real because guaranteed income covers more spending. This is reasonable in a model, but in practice, a retiree must decide whether they can truly hold a more aggressive portfolio. Even if withdrawals are lower, a larger equity allocation will still fall during bear markets. If the retiree sees the account drop and panics, the strategy fails. That is the 57th principle. A stronger income floor permits more risk, but it does not require more risk. Some retirees may choose to keep the remaining portfolio moderate even after annuitizing. That may produce less growth but more comfort. Again, goals determine design. Now let us discuss what happens after age 90. If the retiree lives beyond 90, the annuity continues paying. That is where it becomes even more valuable. The portfolio may also continue growing or may be used for spending. Social Security continues. The longer the life, the more valuable lifetime income becomes relative to a fixed pool of assets. This is the core of longevity insurance. At 95 or 100, the annuity may have paid far more than its premium. The retiree who lives a long time may view the annuity as one of the best decisions they made. The retiree who dies early may not. That is insurance. The 58th principle. The value of an annuity is revealed most clearly in the long life scenario. If you are planning only for average life expectancy, you may underprepare for long life. But someone in the household may live long. For couples, planning to the first death is not enough. Plan for the survivor. Now, let us bring the framework into a practical order. First, estimate annual spending. Second, separate essential and discretionary spending. Third, calculate guaranteed income. Fourth, identify the gap. Fifth, decide how much of the gap must be guaranteed versus flexible. Sixth, evaluate whether the portfolio can fill the gap at a sustainable withdrawal rate. Seventh, stress test bad markets and long life. Eighth, consider partial annuitization if the gap creates too much risk. Ninth, preserve enough liquidity. 10th, protect the surviving spouse. 11th, evaluate legacy goals. 12th, compare after-tax income. 13th, understand inflation exposure. 14th, choose tools that fit the plan. That is the full process, the 59th principle. Retirement income should be engineered from needs to tools, not from products to hope. Start with the need, then choose the tool. Now let us return to the $1 million. $1 million sounds like a lot. It is a lot. But $1 million does not automatically create retirement security. It depends on spending, guaranteed income, market returns, inflation, health, taxes, longevity, and behavior. A $1 million portfolio supporting a $50,000 annual gap is one kind of plan. A $600,000 portfolio supporting a $22,400 annual gap is another kind of plan. The second plan has less liquid portfolio capital but more guaranteed income. The first plan has more liquid portfolio capital but more market dependence. That is the essence of the decision. The 60th principle. The size of the portfolio matters less than the size of the income gap it must cover. A $1 million portfolio with a small income gap can be very strong. A $1 million portfolio with a very large income gap can be fragile. A smaller portfolio with a stronger income floor can sometimes be safer than a larger portfolio with no floor. Now, let us think about peace of mind. Peace of mind is difficult to model but very real. A retiree who sleeps better because $72,600 of income is guaranteed may make better decisions. They may enjoy retirement more. They may stay invested. They may spend without guilt, but peace of mind has a cost. The cost is liquidity, control, and potential inheritance. The correct question is not whether peace of mind matters. It does. The correct question is how much you should pay for it. That is the 61st principle. Peace of mind is valuable, but it should be purchased at the right price and in the right amount. Partial annuitization is one way to buy some peace without giving up all flexibility. Now, let us talk about the difference between income certainty and wealth certainty. An annuity can make income more certain. It does not make total wealth more certain. The portfolio may rise or fall. Inflation may change purchasing power. Heirs may receive more or less. The retiree may live longer or shorter. So do not confuse guaranteed income with guaranteed overall outcome. It is a layer of certainty, not total certainty. That is the 62nd principle. Guaranteed income is one stabilizer inside an uncertain retirement system. It is not the whole system. Now, let us discuss how to think about annuity quotes. A quote is not permanent. It depends on current rates, insurer pricing, age, gender, state, payout option, and features. Quotes can change before making a decision. Compare multiple insurers. Understand commissions or compensation. Understand surrender terms, if any. SPIAs are generally irreversible once purchased. Read the contract. This is not casual. The 63rd principle. An irreversible retirement decision deserves more than one quote and one conversation. Take time, ask questions. Run the numbers. Make sure the spouse understands. Make sure heirs understand enough to avoid confusion. Know exactly what is being exchanged. Now let us think about the broader lesson. People often reduce retirement income planning to slogans. Never buy annuities. Always buy annuities. Use the 4% rule. Never touch principal. Invest aggressively. Stay conservative. Leave a legacy. Spend your money. These slogans are too simple. Retirement is a system of trade-offs. The correct answer depends on the person. That is why the source balanced conclusion matters. There is no one right answer. There are better answers based on goals, risk, comfort, certainty, flexibility, and legacy. That is the 64th principle. Retirement planning is not ideological. It is diagnostic. Diagnose the income need, diagnose the risk, diagnose the behavior, diagnose the trade-offs, then design the plan. Now let us end with the real choice. If you retire with $1 million, you are not deciding only how to invest it. You are deciding how much uncertainty you want to personally carry. A portfolio-only plan asks you to carry more market uncertainty in exchange for more control and upside. A hybrid plan transfers some uncertainty to an insurance company in exchange for less control and lower liquidity. Neither is automatically right. The right plan is the one that lets you live the retirement you actually want, while protecting against the risks that would hurt you most. If your deepest fear is running out, build a stronger income floor. If your deepest goal is flexibility and legacy, preserve more portfolio control. If you want both, consider a partial hybrid. That is the final principle. The purpose of retirement income planning is not to maximize one number. It is to create a life that remains secure across many possible futures that requires both math and honesty. The math tells you what may work. Honesty tells you what you can live with. And when those two things align, retirement becomes less about guessing and more about design. So with $1 million, the question is not simply portfolio or annuity. The question is deeper. How much of my retirement should be guaranteed? How much should remain flexible? How much market risk can I tolerate? How long might I live? How much do I want to leave behind? How much inflation risk can I accept? How much control am I willing to trade for certainty? Answer those questions and the right structure begins to appear. That is the conversation every retiree should have before turning savings into income. Because the money you spent a lifetime accumulating should not be left to a rule of thumb alone. It should be built into a system that pays you, a system that protects you, a system that lets you sleep, a system that still allows growth, a system that respects uncertainty, and most importantly, a system that lasts as long as you do.